of the Philadelphia Board of Pensions and Retirement will be conducted as a virtual meeting using Microsoft Teams conference technology and pursuant to Section 21-1503 of the Philadelphia Code. This meeting is being recorded, and the recording will be made available to the public online at the board's website within 10 days. Please note that you consent to such recording by joining the meeting. Please also note that the meeting software will log the email address and/or the telephone number that you used to join this meeting, and therefore the email address and/or telephone number that you used may become part of the recording and made available to the public. And now we'll call our August 22nd, 2021 meeting to order. And first, I'd like to ask the board members to again adopt our virtual procedures for today's meeting. So motion to adopt the new procedures has been made and seconded. Is there any discussion on this item? Hearing none, we'll proceed with the roll call. Brian Coughlin.
I approve.
Francois Duchy.
Approve.
Vanessa Garrett Harvey.
Approve.
Marsha Green Jones.
Approve.
Nicole McCormick.
Approve.
Veronica Pankey.
Approve, but I'd like to make a notation of the date that you referenced is the 26th and not the 22nd.
Oh, sorry, I'll call the August 26th, 2021 meeting to order. Thank you, Veronica.
I approve.
Thank you. Carol Stukes Baylor.
I approve.
And Ron Stagliano.
I approve.
Thank you. Carries unanimously. That moves us to item 2, a motion to approve the minutes from the July 22nd board meeting. A motion has been made and seconded. Any discussion on this item? Okay, we'll proceed with the roll. Brian.
I approve.
Francois.
Approve.
Vanessa.
Approve.
Marcia.
Approve.
Nicole.
Approve.
Veronica.
Approve.
Carol.
Approve.
Ron.
I approve.
Motion carries unanimously. Moves us to item 3, a motion to approve 150 pension applications and 42 withdrawal applications has been made and seconded. Any discussion on this item? Okay, hearing none, we'll move to the roll. Brian.
I approve.
Francois.
Approve.
Vanessa.
Approve.
Marcia.
Approve.
Nicole.
Approve.
Veronica.
Approve.
Carol.
Approve.
Ron.
I approve.
Motion carries unanimously. That moves us to section 4. 4A, an application to approve the service-connected disability benefits for Jerome S. Williams has been made and seconded. Is there any discussion on this item? Hearing none, we'll move to the roll. Brian.
I approve.
Francois.
Approve.
Vanessa.
Approve.
Marcia.
Approve.
Nicole.
Approve.
Veronica.
Approve.
Carol.
Approve.
And Ron.
I approve.
Motion carries unanimously. 4B, an application to approve service-connected disability benefits for Charles Durham has been made and seconded. Any discussion on this item? Brian.
I approve.
Francois.
Deny.
Vanessa.
Deny.
Marcia.
Deny.
Nicole.
Approve.
Veronica.
Approve.
Carol.
Approve.
And Ron.
I approve.
Motion carries 5-3. 4C, an application to approve the service-connected disability benefits for Charles Grabowski has been made and seconded. Is there any discussion on this item? Okay, hearing none. Brian.
I approve.
Francois.
Approve.
Vanessa.
I approve.
Marcia.
Approve.
Nicole,
Approve.
Veronica,
Approve.
Carol,
Approve.
Ron.
I approve.
Motion carries unanimously. 4D, an application to approve service-connected disability benefits for Richard Johnston has been made and seconded. Is there any discussion on this item? Hearing none, we'll move to the roll. Brian,
I approve.
Francois,
Approve.
Vanessa,
Approve.
Marcia,
Approve.
Nicole,
Approve.
Veronica,
Approve.
Carol,
Approve.
and Ron.
I approve.
The motion carries unanimously. 4E, a motion to approve the service-connected disability benefits for Daryl Knighton has been made and seconded. Is there any discussion on this item? Hearing none, we'll move to the roll. Brian,
I'll abstain.
Francois,
Deny.
Vanessa,
Deny.
Marcia,
Deny.
Nicole,
Deny.
Veronica,
I abstain.
Carol,
Abstain.
and Ron.
I abstain.
Okay, the motion fails 0-4 with 4 abstentions. 4F, an application to approve the service-connected disability benefits for Sean Lamard has been made and seconded. Is there any discussion on this item? Hearing none. Brian,
I approve.
Francois,
I approve.
Vanessa,
Approve.
Marcia,
Approve.
Nicole,
Approve.
Veronica,
Approve.
Carol,
Approve.
and Ron.
I approve.
Motion carries unanimously. 4G, an application to approve service-connected disability benefits for Alfreda Evans has been made and seconded. Any discussion on this item? Hearing none. Brian,
I approve.
Francois,
Deny.
Vanessa,
Deny.
Marcia,
Deny.
Nicole,
Approve.
Veronica,
I approve.
Carol,
Approve.
Ron.
I approve.
The motion carries 5-3. 4H, an application to approve the service-connected disability benefits for Renault Smith has been made and seconded. Is there any discussion on this item? Hearing none. Brian,
I approve.
Francois,
Deny.
Vanessa,
Deny.
Marcia,
Deny.
Nicole,
Approve.
Veronica,
I approve.
Carol,
Approve.
and Ron.
I approve.
The motion carries 5-3. 4I, an application to approve the service-connected disability benefits for Joseph Paul has been made and seconded. Any discussion on this item? Hearing none. Brian,
I'll abstain.
Francois,
Deny.
Vanessa,
Deny.
Marcia,
Deny.
Nicole,
Deny.
Veronica,
Abstain.
Carol,
Abstain.
and Ron.
I abstain.
Okay. The motion fails 0-4 with 4 abstentions. 4J, an application to approve the service-connected disability benefits for Ruben Santiago Jr. has been made and seconded. Is there any discussion on this item? Hearing none. Brian,
Sorry, I approve.
Francois,
Approve.
Vanessa,
Approve.
Marcia,
Approve.
Nicole,
Approve.
Veronica,
Approve.
Carol,
Approve.
and Ron.
I approve.
Motion carries unanimously. 4K, an application to approve the service-connected disability benefits for Kevin Price has been made and seconded. Is there any discussion on this item? Hearing none, we'll move to the roll. Brian,
I approve.
Francois,
Deny.
Vanessa,
Deny.
Marcia,
Deny.
Nicole,
Approve.
Veronica,
I approve.
Carol,
Approve.
and Ron.
I approve.
The motion carries 5-3. That moves us to section 5A, an application to approve the survivorship benefits regarding James Gamble, the deceased, for Antoinette Gamble, a medically dependent adult child, has been made and seconded. Is there any discussion on this item? Hearing none, we'll move to the roll call. Brian,
I approve.
Francois,
Approve.
Vanessa,
I approve.
Marcia,
Approve.
Nicole,
Approve.
Veronica,
Approve.
Carol,
Approve.
and Ron.
I approve.
Okay, motion carries unanimously. 5B, a motion to approve the survivorship benefits regarding Eugene Boyd, the deceased, for Regina Boyd, a spouse, common law spouse case has been made and seconded. Is there any discussion on this item?
So, Jackie,
Yes, Carol?
I saw the letter that the attorney responded back to the board and stuff like that, but what I didn't see in the letter was proof of a lease or a mortgage. Did they submit those documents? Did you know?
I'll ask Fran or his team to speak about this.
Everything that this is everything that they submitted. We have not withheld any information. So whatever is in here is everything that the attorney submitted in response to our request and the law department's request for them to submit any documentation that they thought was relevant, including leases, mortgages, et cetera, bank accounts that could show a common law marriage. So yes, this is everything that we have that we received.
So, can we table this to after that? I mean, I know he made a remark about not having to go back 19 years, but if they've been living together all this time, they should have some kind of current documentation, electric bill, gas bill, something. I mean, that's, I would like to table to see if we can get those documents. If not, we can move on.
Carol, you want to send it right to a hearing panel?
We can do that too.
So is there a motion?
So I make a motion that we send it to a hearing panel.
I'll second.
Okay, a motion to send 5B to a hearing panel has been made and seconded. Is there any discussion on the revised motion? Hearing none, we'll move to the roll. Brian,
I approve.
Francois,
I approve.
Vanessa,
I approve.
Marcia,
Approve.
Nicole,
Approve.
Veronica,
I approve.
Carol,
Approve.
and Ron.
I approve.
Motion, the motion to send this to a hearing panel carries unanimously. That moves us into section 6, old business. 6A, a motion to approve the service-connected disability benefits for Robert Sambuca has been made and seconded. Is there any discussion on this? Hearing none. Brian,
I approve.
Francois,
Deny.
Vanessa,
Deny.
Marcia,
Deny.
Nicole,
Approve.
Veronica,
I approve.
Carol,
Approve.
and Ron.
I approve.
The motion carries 5-3. 6B, a motion to approve the survivorship benefits regarding Elmer Clougs, the deceased, for Jacqueline Carey Clougs has been made and seconded. Is there any discussion on this item? Hearing none. Brian,
Deny.
Francois,
Deny.
Vanessa,
Deny.
Marcia,
Deny.
Nicole,
Deny.
Veronica,
Deny.
Carol,
Deny.
and Ron.
Denied.
The motion fails 0-8. That moves us into new business and the executive director's report.
Good morning, everyone. The trustee election, the ballots are out. They were nailed out on the 19th. And people have been receiving the ballots. We know that because we received feedback. The ballots are due back by the 21st to the provider. Again, that's the instructions were clear that that's not a postmark. They're due back on the 21st. And the live counting of the ballots will take place on September 28th on the 17th floor. The stress test meeting with Councilmember Parker is scheduled for September 7th in City Hall from 12 to 1. So I just wanted to remind the people for that. I know that Carol and the controller have confirmed their attendance as well as myself. So if Brian or Veronica are going to attend, or Ron, just let the council person's office know. The state and annual audits of the pension fund are continuing. They're still in progress, still in the early stages. So I'll keep you posted as they proceed. And concerning future meetings, virtual meetings, we have not advertised for the September meeting or forward at this point. However, I would like to suggest the possibility that the at least the September meeting and possibly other meetings be conducted virtually. If we can always pivot from that if we have to, but because of our advertising requirements, I think it's advisable that we make a decision today, at least on the September meeting, if not more. So, but I will leave that up to the board. That's all I have right now.
I'd like to make a motion that all remaining board meetings for the 2021 are virtual.
Thank you, Veronica.
I
Is there-
second that. I second that.
Thank you, Marcia. The motion to remain virtual for the remainder of 2021 has been made and seconded. Is there any discussion on this item? Hearing none, we'll move to the roll. Brian,
I approve.
Francois,
Approve.
Vanessa,
Approve.
Marcia,
Approve.
Nicole,
Approve.
Veronica,
Approve.
Carol,
Approve.
and Ron.
I approve.
Motion carries unanimously. Fran, is there anything to note under the business and education authorization?
Jackie, real quick, Brian here. As far as the election, Fran, I have a member who stated to me he received all the information, but there was no ballot in the envelope. Is there a way to address that?
Yes, he can contact the provider directly. There is a number on there for the provider, and they will resend the ballot. Bill, correct me if I'm wrong about that.
Oh, that's correct.
If I win by one vote, am I going to have questions to answer? I'll have him call, buddy. Thank you.
Thanks, Brian. And Fran, I just wanted to confirm that we can move to litigation summary. Did you have anything
Yes,
else?
you can. No, you
I
can.
do have a question. Fran, did you say the September the 2nd or September the 7th?
For Councilwoman Parker, it's September the 7th. It was rescheduled. I think it was originally September the 2nd. It was rescheduled to September the 2nd, 7th, 7. 07 at 12 to 1, room 576, City Hall.
So now I have one more question, like how come no one on the administration side has attended this meeting with us?
Well, the invitation went to those who signed the letter.
Yeah, that was another thing. How come we only the trustee, the elected trustee signed the letter? Like, don't we have 9 voices on the board?
We do, and everyone was given the option of signing. Well, it went to Rob on the administration side and to all the elected trustees.
Well, I just want to let y'all know that I feel some type of way that the administration that was out there just sinking this south when this decision or vote had to go for it. But we need more than 4 votes to make it pass. So I don't think it's fair in the position that the elected trustees are being put in, and the administration is not taking a step forward to do anything. So I just want to put that on the record, and I want it in the minutes. Thank you so much.
You know, since the meeting's being recorded, everything we say will be on the
Thank you.
on the record. So. Yeah.
Mhm.
Okay. Any other new business before the board? Okay, we'll move to the litigation summary.
We have a few cases in common pleas and no other cases at the moment.
Thanks, Ellen. So a motion to adjourn has been made and seconded, and hearing no objections, the motion carries unanimously, and we will move into the deferred compensation portion of our meeting. Item 1 is to approve the minutes from our July meeting, and there's been a motion that's been made and seconded. Any discussion on this item? Hearing none, we'll move to the roll. Brian?
I approve.
Francois?
Approve.
Vanessa?
Approve.
Marcia?
Approve.
Nicole?
Sorry, approve.
Veronica?
Approve.
Carol?
Approved.
And Ron? Ron, I think you're on mute.
I approve. Sorry.
That's okay. The motion carries unanimously, and that moves us into item 2, the plan update and activity report.
I'm sorry, I couldn't get it off mute. Can you guys hear me? Good morning. There will be an investment update following Nationwide's activity report.
Thank you, Dominique.
Brad, Bina, Jeff.
Good morning, everyone. How are you all? Going to be talking about the
Good morning.
Good morning. Good morning. The July deferred comp and 401A plan summary. As of July 31st, the ending balance in the deferred compensation plan was $1,712,778,424.26. That's about 1.3% increase above last month. The total participants in the plan is 24,482. That's 35 less than end of June. Actively deferred participant count is 19,093. That's about 33%, 33 less than the month of June. New enrollments, we received 121 new enrollments. That's 77 more than the month of June. Year to date, total enrollments received is 735. That's still 10% more than last year around the same time. Inactive participant is 5,389. That's 2 less than previous month. In the 401A plan, the ending balance is $1,541,561.75. Total participants is 785. That's 3 less than the previous month. Call volumes handled was 2,915 calls. That's about a decrease of 59 less than previous month. And in terms of online accounts, We have now 70% of participants that have an account balance have an online account. This is where they can leverage the planning tools and resources, attend webinars, as well as schedule one-on-one appointments with the retirement specialist. There are 871 participants in the percentage. That's an increase of 44 more participants since the month of June. In Roth 457, there are 3,453 participants that are enrolled in the Roth. That's an increase of 71 more than previous month, with total plan assets of about 14.9 million. I'm happy to answer any questions. If not, I'm going to pass it on for Brad to discuss the service activity report. Thank you. Brad?
Thank you, Bina. Good morning, everyone. So for the month of July, the local office team conducted 240 one-on-one consultations, and that resulted in 114 enrollments for the month of July. By far our biggest month in a long time, mostly because we had a police academy class that we were able to attend. Thank Ron for going in the morning and setting the stage for us to come and present. The team conducted 10 webinars for 186 attendees for the month of July. And of those one-on-one consultations, 40 of them were using the My Interactive Retirement Planner. Now, at the last meeting, Veronica asked if we could report out on our new enrollments, how many of them are new hires to the city. And of the on our application, date of hire is not a required field. So we have 74 of the 121 folks that were hired that we have a date of hire for. And of those 74, 56 of them were hired in the year of 2021. So a pretty good snapshot of the folks that were hired of the new enrollments. Veronica, I hope that answers your question and request from last month.
Yes, it does. And Fran also shared with me that a letter has gone out or is going out to new hires that aren't participating in the deferred comp plan, which I'm appreciative of. Thank you.
No, thank you, Veronica. Fran, if you'd like, I can address that real quickly.
Yeah, Brad, that would be great. I know September 2nd, and you shared the letters with us, and we had opportunity to give feedback, and they're very good. But yeah, sure, that would be great.
Thanks, Fran. So, yeah, on September 2nd, we're going to be sending out an email and a hard copy mailing to anybody that we do not have an email address for, to basically what it is it's anybody that is enrolled in pension plan 10 or 16 that is not participating in the deferred comp plan. It's about 800 folks. So we're going to be sending an email that gives them the ability to click on that email to join the 457 plan, therefore supplementing their retirement savings, hopefully. One of the nice things about being able to do this type of campaign is that we'll be able to report back to the board and staff on a delivery rate, the rate that employees open the email, the rate that they click on the email, so that we can actually judge the effectiveness of the campaign. If, we send it and only 20% of people open it, then we probably need to come up with a new tactic so we can use that and to judge it. So that will be going out on September 2nd.
That would be great, Brad. Additionally, can there be an adjustment made to the application to add the date of hire so that your tracking could be easier?
Absolutely, Veronica. We're actually in the process of doing that already. I'm sorry, I didn't mean to interrupt.
Okay, thank you. Thank you.
No problem. So that is all I had, if there are no other questions.
Thank you, Brad and Bina. Any other questions? Okay. I think that moves us to item 3, the second quarter investment performance.
Thank you, Jackie. So looking at staff's report, performance has been largely positive. As of the end of second quarter, June 30th, 22 of the 24 funds are showing peer rankings above median in the 3 to 5 year periods, those longer term periods. There are no actionable concerns with any of the funds at this time. The one actively managed fund that was a part of the two that are showing longer term underperformance is the Mass Mutual fund. Just want to note that the funds are compared to a universe of both actively and passively managed funds in the Lipper universe, and so this is an area where the benchmark has been ranked top decile. So the benchmark has been difficult to outperform for many of the active managers, which it would also indicate that passively managed funds in that universe are probably ranking higher, which is, likely why you're seeing some of that underperformance, although we will continue to monitor that particular fund. So unless there are any questions, no other updates on the performance, and I can move on to the money market update.
Thank you, Dominique.
Sure. And so the Vanguard money market update, the deferred compensation plan holds a money market account used to pay reasonable administrative and operating expenses of the plan. When the assets in the account reach a threshold of $1 million, typically the board has voted on whether to issue a rebate to participants in a plan. For reference, at the September 2015 meeting, which was the last rebate, the board voted to issue a rebate in the amount of $1 million on a prorated basis through all participants based on the respective account balances as of the second quarter at that time. So that would have been June 30th, 2015. The board also voted to maintain assets of at least 3 years worth of reasonable expenses at that time, which were around $10,000 per year. So that would have been a minimum account balance of $30,000. So as of June 30th, 2021, the account balance was $1,032,016.98. So staff's recommendation based on reaching that threshold of over 1 million is to issue a rebate in the amount of $1 million. Maintain a balance to cover any potential expenses, and also to maintain a balance of $32,016.98. So that would be the difference, and that also covers that recommended $30,000. The rebate is being recommended prorated to all participants, again, based on their respective account balances as of June 30th. So are there any questions? So I believe
Is there
The motion to pay the money out, Dominique.
That's what we're waiting for. You would need to vote, yeah.
So I make a motion that we pay out the money rebate.
I'll second.
Carol, is your motion to accept staff's recommendation? You cut in and out.
Oh, I'm sorry. Yes, it is.
Okay, is there a second?
Yes, I'll second.
Okay, motion has been made and seconded. Is there any discussion on this item? Hearing none, we'll go to the roll. Brian?
I approve.
Francois?
Sorry, approve.
Thank you. Vanessa?
Approve.
Marcia?
Approve.
Veronica?
Approve.
Rebecca?
Approve.
Carol?
Approve.
And Ron?
I approve.
Okay, motion carries unanimously. And a motion to adjourn the deferred comp portion has been made and seconded. Any discussion on this item? Hearing none, we'll move into the investment committee.
Thanks, Jackie.
to call the investment committee to order. First item is approval of the minutes from the July board meeting. It's moved and properly seconded that the minutes be approved. Any discussion? We'll call the roll. Brian,
I approve.
Francois,
Approve.
Vanessa,
Approve.
Marcia,
Approve.
Veronica,
I approve.
Rebecca,
Approve.
Carol,
Approve.
and Ron.
I approve.
Thank you. Motion carries. Takes us to agenda item 2, which is the diversity and local brokerage report.
Good morning, Rob.
Morning.
Everyone. This is the first quarter 2021 minority, local, and woman-owned brokerage review. We'll provide the second quarter data in the September meeting. As the board's aware, the funds managers are encouraged to direct 35% of their trades on an aspirational balance to approved female, minority, and local brokers. Positive start to the calendar year for the board's equity managers. You'll see that 51% of their trades went to qualifying firms, with Ariel directing the highest percentage at 100%. Also, just as an information item, while we do review this, data on a quarterly basis, it does tend to ebb and flow a little bit. Just a couple of examples. Fiera, who was at 25% for the first quarter, actually directed 70% of their trades to qualifying brokers in 2020. Investors Group, who was at 16%, directed 37% of their trades in 2020. And then the small cap international managers as a whole, which only directed 22%. This quarter directed 37% last year. So again, good to look at it quarterly, but the longer term trends there are positive. The third page just reviews the specific brokers over the first quarter that the managers directed their trades to. And then similar data provided on page 4 regarding the fixed income managers. Very close as a group to the 35% aspirational target, with several managers well above it. MetLife, who had historically been in the single digits, is up to 26%. SIM, who was, I believe, even lower than them when we first started with that group, is now pushing 60%. So largely positive data there as well. And again, we'll provide the second quarter data at the next meeting.
Thanks, Chris. Any questions about that? Okay. The next agenda item is the asset allocation review and discussion.
Sure. I'll just make a couple of brief comments, and then I'll turn it over to the folks from Marquette. As the board's aware, on an annual basis, the staff and consultant will review the asset allocation and provide recommendations, if any, to the trustees on the investment portfolio and lineup as a whole. On page 2 of the PowerPoint presentation from Marquette, you'll see the high level rationale and reasons and what they further review and what we hope to cover today. Discuss the historical performance and the current asset allocation of the portfolio. Highlight that since the changes the board began making back in 2016, we've seen minimal performance surprises since then. Along with Marquette, staff is not recommending changes to the current asset allocation. We'll touch on the fact that the asset allocation process looks at the portfolio from a long-term perspective, and we'll discuss how various composites and indexes have performed over that time. There'll be some brief discussion on more recent changes on the macroeconomic environment. And then there will also be some discussion on the recommendation to continue allocating funds to a low volatility equity strategy. Happy to take questions, as is Marquette, as they walk through the document. And with that, I'll turn it over to Kwaku, Dave, and the Marquette team.
Great. Thank you, Chris. And good morning, everyone. As Chris mentioned, the purpose of this discussion is really just, again, to walk through the asset allocation. As we know, we went through a pretty meaningful change a number of years ago with the board's direction, along with staff, with respect to making tweaks in the portfolio, moving away from energy, some of the more volatile components of the market, and really having more of a steady type exposure to the market ups and downs through some of the allocations that we put in place. Ultimately, on page 3, the takeaway here is asset allocation is the key driver of the variability of returns in the portfolio. And we'll move through a couple of the slides relatively quickly, given the fact that they really just surmise where we are today and the journey we took to get there. Slide 2, Chris just walked through what the goal is of today's discussion. So no need to really spend time on this particular slide. We just went through slide 3, which points to the importance of asset allocation, really around the driving of returns and those the variability of returns within the portfolio. The next slide, please. Just highlights the new course that was taken back in 2016. We think about where the portfolio was. We think about where the portfolio is today. And as an example, some of the areas that we've highlighted, absolute return on the middle of the page, that's a nice term for hedge funds. We see here that we went from an allocation of 6.3% to virtually just a rounding allocation. MLPs, master limited partnerships, a proxy for the energy sector, that also comprised meaningful allocation within the portfolio. That is no longer there. And once again, that really just reinforces some of the deliberate tweaks that were taken in the portfolio to help minimize some of the opaqueness in the return stream, and then also look at more cost-effective ways of gaining diversification within the market. The next slide, please. Is just a pie chart representation of what we just discussed. So nothing else to add on this page. Again, it just provides a nice visual representation of where we are today, where we were back in 2016, and then ultimately the difference between today's current allocation and the target policy. The next slide, please. This begins a timeline, and these timelines are just a really nice reflection of the work, the pacing, the discussions, the debate, the analysis that's taken place over the years. So we see here on these particular pages, we walk through the discussions that staff and Marquette had with the board. We walk through some of the symposium topics that we've discussed with the board members. We talk about the education we've had around strategic asset allocation, reviewing the portfolio, reviewing where we are an outlier, reviewing areas where we were looking to incorporate other types of risk beyond where we were at that point. MLPs, once again, absolute return, once again. And then the asset allocation discussion, the approval of the asset allocation, and then really just jumping through to the next couple of slides. The next few slides then just point to actions taken. So we see, for example, in 2016, a lot of discussion took place on setting up the portfolio for a greater probability of success over the long term. And then 2017, beginning on page 7, we see here a number of searches, a number of discussions that really, again, just reflect asset classes, managers, exposures that were incorporated into the portfolio. We continue to go on to slide 9, slide 10, slide 11, 12, 13, and 14. And these, once again, really just underscore the blocking and tackling, the consistent discussions, the manager reviews, the manager searches, the changes that have taken place in the portfolio. So again, the purpose of these slides was to really just reinforce how much heavy lifting has been done by the board, how many discussions staff and Marquette have taken to the board. And then the proof in the pudding is really in slide 15, where we take a look at the performance attribution. So this is 1 year looking back as of June 30th of this year. And as we know, June 30th of 2020 incorporated a significant period of volatility within the market. The proof in the pudding for us was back in 2016, we looked at it, the asset allocation, we had a discussion with the board, and the appetite was really to, again, take away some of this outlier risk, some of the more academic ideas in the portfolio, MLPs, energy, and so on, had not translated to the type of return stream that the board was looking for, or that staff or Marquette thought would be the most consistent path to approach for the long term. And as of June 30th of this year, looking back 1 year, the portfolio increased 26.72%. We did outpace the policy index, and we did outpace the actuarial rate over that 1 year period of time. The next slide, just to really drive home the purpose of. Yes.
Does the fact our composite was kind of right by the benchmark valid, kind of drive home the point you were making that we are kind of more normal now than we were 4 or 5 years ago?
Absolutely. Yes, absolutely. While we can't control, unfortunately, what the market's going to do on any given basis, the goal is to really minimize, this extreme tracking error, the surprises that you see within the portfolio. So absolutely, looking back on that 1 year period, given the fact that we were a little bit ahead of the benchmark, so that's definitely a great place to be, but not so significant. Just points to, again, a strategy that's working nicely for us. So absolutely.
Thanks.
And with respect to the next slide, just points to the performance of the various composites over that same period of time. We see that the composite performance, no real surprises. Equities rode the market down when the market went down, but equities rebounded significantly when the market rebounded. Private equity, real assets, these were areas of the portfolio that ultimately held up very, very well for us. With respect to fixed income, this is one area of the market that is going through some pressure because of interest rates, but ultimately no surprises in how we're looking at the performance of the portfolio. With respect to absolute return, there is one manager we have in the portfolio, Elizabeth Park, a diverse owned manager, really specializing in the banking sector. Their thesis and what they do has made a very strong case for their continued inclusion in the portfolio. With that being said, their extreme performance of 61.7% really underscores why we've limited our exposure to hedge funds. We love the 61.7% performance, but as we know with Elizabeth Park, there have been periods of tracking error within the portfolio. So again, really being selective on who we wanted to keep in that segment has been very beneficial for us. Moving to the next slide, please. Again, I think this is an excellent slide. And, in a market environment where everything goes down, unfortunately, we do participate in the downside. That's the unfortunate reality of being an investor and being a plan that has to extend beyond, let's say, cash to get a target rate of return. However, what we are looking to do in our asset allocation is perform better than the market when we go through an extreme pullback. And we actually did see that when we think about the overall returns of the portfolio in blue. This is during the first quarter of 2020, an extreme pullback in the market due to COVID-19. And we see here that we were down 15.9%. So again, reflecting the fact that it's never good to see negative returns. the reality there is we can't avoid negative returns when the market is down. What we can look to minimize, however, is again that extreme behavior within the portfolio. And we see that, compared to the segments of the market that we have exposure to, the portfolio held up exceptionally well. So once again, the diversification, the exposure to managers that were able to add value. Even one of the managers on watch, for example, UBS, relative to other managers and other asset classes during the downturn, they were actually a source of positive return for us. So a very nice story to see on this page. And once again, really, nice proof in the pudding that the long-term strategy that has been set in play has been working for the plan. With respect to UBS, the goal here is to really just walk through UBS's turnaround in performance. As we know, UBS has been scrutinized by us over recent quarters. The portfolio did go through some write-downs. It did go through some headwinds. But as we've discussed in prior meetings, we have begun to see a turnaround within the performance of the portfolio. Some of the things that we can point to as positives are, for example, the leverage ratio of UBS. They continue to be a lower leveraged manager, and that's one reason why we looked at UBS as a good anchor allocation within the portfolio. With respect to leverage, the more leverage you take, particularly in a lower interest rate environment, the higher your expected return. While things didn't really translate how I think anyone thought they would with respect to interest rates going down once again, this COVID pandemic we're going through and so on, ultimately the relative defensive positioning of UBS from a leverage standpoint, shows their return being what it is relative to the Odyssey index, which has a higher leverage ratio of 22.6%. The write-downs that were realized last year, are reflected in those longer-term returns. However, shorter-term returns, again, continue to show that there is a stabilization. There appears to be a stabilization in UBS's portfolio. The redemption queue, for example, has shrunk significantly. We're looking at a 7.9 billion redemption queue. The loyalty program, which is also important to mention, which is the clients in UBS that have essentially signed up to not redeem assets. They've signed up to not redeem for a period of 2 or 3 years, depending on which loyalty program they've signed up for. Again, that number being close to 5 billion also points to additional comfort, additional happiness with the UBS turnaround strategy. The next slide, please.
Quaco,
Yes.
this is Fran. How you doing?
Hey, Fran.
Good. What's the aside from the loyalty program, where you said people agreed not to receive their redemption until 2 or 3 years down the road? What is the normal wait time for the redemption queue outside the loyalty program?
Yeah, so outside the loyalty program, we've begun to see payments take place at a bigger clip. But last year, long story short, last year when redemptions were placed in, we were given an estimate of around 18 to 22 months. That was last year when those redemption requests were placed in. And the good news is, again, we've seen redemptions happen at a slightly quicker clip in 2021.
So is the queue going down because less people are redeeming, or because they're paying out money?
So the queue is going down because less people are redeeming money, Fran. So they've not paid out so much that the queue would have gone down by such a significant amount. It's the converse of that. When last month we were talking about inflation. We were also talking about equity market volatility and so on. Ultimately, these headwinds in the market have led some investors to go back and look at real estate and the role of real estate in a portfolio, and that's been beneficial for UBS as well.
And does their recent stabilization, as you called it, change your recommendation or analysis concerning our redemption?
Fran, so no, it doesn't change the analysis. We still think it makes sense to continue with the redemption. We think it does make sense to, as we receive those funds, to look out to the marketplace for another core manager to take those funds. So no changes from our standpoint with respect to action that we're recommending.
Okay, thank you.
Perfect.
Hi, this is Rebecca Reinhardt following up on Fran's questions. How much was actually redeemed and how much were people reversing their request for redemption? And I know you just said to Fran that it wasn't, the reduction in the redemption queue is not because of actual redemptions, but I'm just curious to see the actual numbers of how much, the number of investors, how many investors are still in the fund, what's been redeemed, and then who's actually just reversed it.
Absolutely. And for that question, Rebecca, would it be okay to follow up with you on that?
Absolutely.
Okay,
Sure.
perfect. Thank you.
Thank you.
So we'll follow up on that. We'll circle back with Chris with some of those numbers and get those to you.
Great, thank you.
Perfect. And with that, I'm going to pass it along to Dave to walk through the remainder of the presentation.
Thank you, Kwaku. Good morning, everyone. Maybe if we could just scroll back to slide 20 just quickly. And another part of the phenomenon really that's helped alleviate redemption queues across the core real estate space more broadly, not just UBS, is we've seen institutional investor portfolios benefit from a significant public equity tailwind. Investors, by and large, are now overweight public equity, bringing those levels back down to goal weights and reallocating to asset class underweights, namely fixed income and real estate. So we are starting to see institutional investors recommit capital to their core real estate or real estate allocations to maintain their goal weights. We are starting to see money come back into queues, and that's bringing queues back down. And that's a broad statement across core real estate just in general. What has really helped UBS is we've started to see hopefully a better alignment, better performance, more performance improvements are overweights to multifamily or apartments and overweights to industrial. Industrial space, not surprisingly, has really benefited from this e-commerce tailwind. Warehouses, industrial centers that support this work from home lifestyle that's requiring the Amazon effect. By contrast, real estate has deteriorated over a period of time in advance of COVID. COVID just helped accelerate some of the deterioration in real estate, or in retail. And retail now represents the most significant underweight or the smallest allocation within the core real estate space. UBS is underweight retail, underweight office. In apartments or multifamily, and we saw this phenomenon following the global financial crisis, tends to do the best during periods of inflationary pressures, during periods of rising rates, because that term or that lease is the shortest. Most multifamily units have a year-long lease, so as prices start to reset, those leases become more and more expensive. By contrast, industrial spaces, office spaces, those tend to have longer lease periods, and the interest rate sensitivity, the inflation sensitivity tends to be lower. So the positioning in overweights by UBS to industrial and multifamily is creating a tailwind for performance improvement. And on the following page, just to reiterate some of the points that I just made, the opportunities really exist within the industrial space and multifamily. Industrial, of course, has benefited from an e-commerce tailwind. Apartments are benefiting from inflationary pressures. By contrast, retail has deteriorated, not a big surprise. Office probably has the area of most uncertainty. We are still trying to come to terms with what employee-employer relationships will look like across big cities, across suburban environments, continuing to push back work from home due to increases in the Delta variant, make the outlook a little less certain. We can scroll ahead to slide 23, please. Just an illustration of yield or cap rates relative to Treasury and relative to corporate fixed income. And we think about the broad objectives.
Hey, sorry, can you go back to the risks and opportunities page? None of that it sounds like it's significant enough for you to rethink our allocation.
It's not. And we think about the way that we've allocated to real estate. We have exposures to the core open-end area of the market, which really consists of these four asset classes: industrial, multifamily, office, and retail. These are buildings that are very well occupied. The occupancy is normally north of 90%. These are buildings that don't require rehabilitation, renovation. We are truly benefiting from really two key characteristics: rising market price, which over time tends to be consistent with inflation. And if we are in a period of inflationary pressures, the value of these properties should increase. And then the income component, the inflation or the market value appreciation over time should be around 3%. The income component should be close to 4%. All in, our expectations for real estate should be between 6.5% to 7.5% over a long period of time. The fact that these buildings and assets are very well occupied and very well leased means that the tenants are paying their rents on time, and we are collecting a very healthy income. The diversification and income component is very critical to this part of the allocation. We saw protection from it during the COVID crisis, and this was the only asset class in 2018 that offered positive returns as interest rates increased, bonds were flat, and equities were down. This is a key source of income and diversification.
So I guess to put it a different way, we wouldn't change our allocation to real estate. We might change our allocation within real estate. Right.
Yeah, that is that. Yes, sir.
Okay,
That's
got it. All right, thanks.
And so again, just to underscore the reasons why we have allocated to real estate, it has to do with the fact that yields from fixed income continue to come down. Interest rates are very low. After the global financial crisis, we saw short-term rates eke back up to around 2.25%, only to come back down. We have a very low 10-year yield. We have a very low 30-year yield. The yield that we can get from treasuries or U.S. government issuances, which is the best source of protection during periods of dislocation, are incredibly low, at all-time low levels. By contrast, the yield or the cap rate that we're able to earn from real estate is more attractive than treasuries and more attractive than we're earning from corporate bonds. Very healthy source of income, very healthy source of yield. And then more importantly, for an asset allocation perspective, especially given the backdrop of the inflationary pressures that we expect to see probably over the course of the next few years as the Federal Reserve ends or winds down its bond buying program. Tapering is the talk of the day with the Jackson Hole Symposium occurring today, is the correlation to inflation or alleviation from pressures as interest rates start to rise or inflation starts to rise. And this is on the next slide, 24, please. As I mentioned earlier, apartments tend to have the highest correlation to inflation because their rent or their duration of the lease is the shortest. We tend to see higher and higher rents as inflationary pressures increase, and it's not surprising that apartments or multifamily units are most sensitive to inflationary pressures. Retail, surprisingly, from an income perspective, also has a high correlation. Broadly speaking, real estate across these four sectors tend to offer protection during periods of rising inflation, which is something that we could expect to see over the next 2 to 3 years.
Hey, Dave?
Yes, sir.
It's Fran. Do you, speaking of inflation, you mentioned the last 2 to 3 years, I'm sorry, the next 2 to 3 years with pressure on inflation. We hear talk about transitory inflation. I assume if you're thinking the next 2, 3 years, you're probably thinking, I mean, I don't know what the definition of transitory is, but are you thinking it's not as transitory as maybe we've been led to believe?
No, and we spent a lot of time on this. I think at the last meeting, looking at inflation in depth, and I think it's healthy to recognize that the spike in CPI is due to a disequilibrium between supply and demand. We saw a resurgence following what would appear to be a recovery from COVID. Now, of course, that's, maybe there's some skepticism around what that recovery actually looks like, but there were logistic bottlenecks that drove up prices. We saw lumber prices increase, commodity prices increase, and we've started to see that come back down. But to the extent that the Federal Reserve is slower in raising interest rates, is slower in winding down their bond buying program, we could see some inflationary pressures as a mismatch from interest rates and overall economic overheating. One of the most interesting observations comparing this to the global financial crisis, is this labor shortage and the increase in wages. We are starting to see a spike in wages across almost every single discipline, and that could lead to some inflationary pressures. Now, it's not necessarily going to be outlandish. We don't, we're not walking back any of the commentary that we made at the last meeting, but to the extent that there are inflationary pressures, real estate is going to offer one of the best sources of protection, along with our other real asset portfolios.
Thank you, sir.
Maybe any other questions on real estate before we move on? I think we can jump ahead to 32. And, when we think about overall asset allocation, we're achieving growth to meet our longer term expectations and obligations adjusted for inflation through public and private equity. We're generating income through a fixed income portfolio, and we're diversifying risk, mitigating risk through asset classes like real estate and real assets, but we're also trying to drive down costs. And one of the accomplishments that we've all achieved over the last few years is driving down investment costs. So net of fee returns have improved as the costs have come down in the portfolio. We're leveraging scale. We've been more thoughtful about the way that we've indexed, and all of that has helped drive down fees. Total investment fees relative to the industry or the peer average across a similar portfolio are materially different, as evidenced by the total at the bottom of this page. Driving down costs is one of the most predictable ways to help improve net of fee returns. 34, just an interesting observation, and a reminder that diversification is essential. It's very difficult to predict from one year to the next which asset classes will perform better than others. So having a diversified approach across growth assets, income generating assets, and diversifying asset classes become very important. But one of the things that we can observe is that over a longer term period of time, public equities, private equities will offer the best source of return, but those are also going to be the biggest source of volatility or illiquidity in a portfolio. But we generally are compensated by taking those risks. The volatility risk, the illiquidity risk leads to the best source of return over the long term.
And
Probably
really
better. Oh, sorry, Clayton.
Dave, I was just going to say, just teeing this up for, your comments on global low vol. I was going to, reemphasize what you just mentioned regarding the predictability of asset class returns over any period of time. This year we're seeing commodities go through a tremendous rally. Obviously, that's not something we'd recommend going into within the portfolio, because we ultimately take a look at commodities back in 2015. We look at commodities back in 2014, significantly negative, right? So the goal isn't to try and time the market. Again, the goal is to have a very thoughtful, consistent process in place that helps us over the long term. And this actually takes us to the next few slides that point to the realities that we're going to face for a number of years. When we think about the portfolio, on the next slide, please, where we think about equities being the key portion of returns for the portfolio, fixed income having to be more of a quality ballast for us. This, again, brings into front and center the discussion around global low volatility. Ultimately, with volatility in the equity market, valuations where they are with the equity market, fixed income being an area with yields poised to rise, but yields being in an uncertain place, fixed income not being that reliable source of income for us, that again brings front to center the importance of global low vol. And on 36 and 37, we do talk about the headwinds facing certain asset classes, fixed income being one of them. If we think about the target rate of return, and on page 37, we think about the expected return coming from fixed income as compared to back in 2010. 2010, we could have expected 4.8% to come from fixed income. Right now, it's 1.7%. So again, equities are going to have to work a little bit harder. However, when we think about valuations in the equity market, when we look at pages 39, when we look at pages 40, and then 41, they point to the volatility of the equity market. So that once again really sets up the discussion for looking at global low volatility as a nice way of providing a little bit more of a ballast in the risk-seeking component of the portfolio. So with that, Dave, I'll kick it back to you. Really just wanted to set the stage for that portion of the discussion.
Yeah, thanks, Kwaku. And maybe back to 41, because that is an interesting illustration. We experience within equities, and especially the S&P 500, a tremendous amount of volatility. A drawdown or a correction is a sell-off of 10% or more on average dating back to 1990. We experience a 14% annual drawdown. Now, that may not occur from one period to the next, but over time, that is the expectation. And what we hope to achieve by allocating to global low volatility, which tends to allocate or over-allocate to more defensive sectors like healthcare, utilities, consumer staples, is mitigate or narrow that amount of drawdown to lessen the overall volatility that we can expect from our traditional long-only managers. This is still long-only equity, where we just have allocations to more defensive sectors within global low volatility strategies. So again, just to reiterate some of the comments that Kwaku has made on 43, is that equity valuations are high. They are poised for a correction, or perhaps poised for some sort of drawdown. Not suggesting that that could happen, but a rise in interest rates certainly will make it more difficult to support higher equity market valuations. Investors have a huge appetite for risk. We've seen a very healthy tailwind from cyclicals in particular over the first quarter, the first maybe 4 or 5 months of the year, but valuations are high. Moving into an asset class that helps mitigate some of that volatility and the likelihood for higher drawdowns really is the defining thesis for global low volatility, narrowing or mitigating that amount of drawdown. The goal allocation within the recently approved asset allocation to global low volatility is 10%. We hope to walk into that slowly over time by making allocations or commitments to 2 of the selected managers that are around 100 million across the 2 managers. But the idea here is to add, and this is on 44, very cost-effective way of mitigating portfolio volatility. In the past, we've explored this portfolio as allocations to hedge funds or hedged equity as a very expensive way to manage the equity drawdown or volatility in a portfolio. These are allocations to long-only equity that should help mitigate and improve the overall expected Sharpe ratio. And then just some commentary over the performance of global low volatility, really starting on 45. The metrics are attractive, and this is on 45. For the trailing 10-year period ending June 30, 2021, the return per unit of risk compared to a global index, the MSCI All Country World Index, is more attractive. We are earning a very similar rate of return, but with less volatility, and that leads to a healthier Sharpe ratio. Sharpe is a measure of return per unit of risk. And ultimately, that's what we're trying to achieve, an attractive equity-like return with as little volatility as possible. And that's what's appealing to us about the asset class, and more importantly, the managers that we've selected. On 46, where we look at annualized return, not surprising that long-only equity or traditional long-only equity has performed a little bit better, but that's okay. We are still looking at risk-adjusted returns, and we notice that the risk or volatility over an almost 20-year period is meaningfully lower. And again, that's what we are attempting to achieve, is more attractive risk-adjusted return. Happy to pause here to address any questions on global overall, the other asset classes in the portfolio, justifications for staying the course. It is healthy to examine this at regular intervals, but we should not feel compelled to make changes every year, every other year.
Right, and I guess the overall conclusion is nothing that happened in the last year fundamentally changed the market in a way that should make us re-examine our asset allocation.
No, sir, we are not recommending changes. We still believe in having this allocation to growth, income, and diversifying asset classes. And what is, I think, very helpful about the way that we've asset allocated, while we can always expect uncertainty from markets, we were not caught flat-footed, nor were we surprised by the way the portfolio behaved during a period of equity market sell-off. We knew that we had exposures to public equity. Those asset classes went down, they came back up. We also knew that we had protection from asset classes like treasuries, core fixed income, and real estate. We weren't surprised or taken aback by the way that this portfolio performed during a period of sensitivity. We were prepared for it. We had stress tested the portfolio, and when an event actually occurred, it was consistent with our expectations and hopefully what we have communicated to the board over the years.
Thank you.
Dave, historically, a substantial portion of global low vol has been financials, including banks, healthcare, but financials. Kwaku talked a little bit about the volatility of Elizabeth Park earlier, and I know they are only banks and regional banks. It's quite different than larger financial institutions. But do you see that due to interest rates, financials, including banks, have been acting maybe a little different than they have historically? How do you see that going forward as far as it relates to global low vol?
Yeah, and Fran, that's a good question. And global low vol managers can achieve their desired outcomes in a variety of different ways. And one of the key takeaways that we uncovered during our manager interviews is making sure that we avoided low volatility managers that had a value bias. Value bias tends to be more defensive, but also during the last few years, we've seen those value biased or those cyclical sectors really underperform. And cyclical sectors typically include financials, industrials, materials, and those are sectors that have really suffered. They experienced a tailwind as the economy improved over the course of the last 6 months, but financials are part of that. During a period of rising interest rates, yes, financials should outperform, but during periods of relatively low rates, and if that persists, financials could be challenged. Both of the managers that we've selected, MFS and Fidelity, have relative underweights compared to the ACWI to the financial service sector.
Okay, but they can obviously, if interest rates go up as we anticipate, you anticipate that the managers will pivot towards that asset class, I assume.
That should be a likely outcome. Financials typically are healthy dividend payers. Healthy dividend payers or that consistent income stream helps offset some of the volatility from just stock price appreciation. So yes, I think that's a logical assumption that we would see a pivot towards financials if we see a yield curve steepening.
Okay, thank you.
Dave or Kwaku, just a question. So with the current state of Afghanistan, do we have to worry about, our asset allocation, or do we feel comfortable at where is that internationally?
Right. So the short answer is the events in Afghanistan will not materially impact the way that we're asset allocated. I would argue that we have been in a period of geopolitical shock for the last 2 decades, and markets don't seem to be very nerved by those conditions, whether it's terrorist attacks in U.S. soil, whether it's ongoing conflict in the South China Sea, Middle East conflict. Markets tend to be resilient. When we think about the overall GDP of Afghanistan, it is very, very small. We don't have allocations to frontier markets. We don't have allocations to any equity in markets like this. So the actual physical impact to the portfolio is negligible, and the overall macroeconomic impact to political tensions or tensions in that part of the world don't seem to have an impact on investors more broadly. But obviously, that's a very important question, and it's something that we are paying close attention to. The news lines all over the news, but the overall implications to a portfolio like this are immaterial.
Thank you.
You up to the stress test now, Dave, or?
Yes, sir. So, the stress test just reiterates the observations, that we really experienced firsthand. And, the broader themes, what can impact the portfolio? And that's a sell-off in equities, a bear market, which is a sell-off of 20%. We actually experienced a sell-off of 30% over a year ago, or if interest rates increase. And the likelihood of interest rates increasing is probably a bigger threat at the moment than equity selling off by 20% or more. And when interest rates start to increase, the valuation of equities or the cost of capital becomes higher, the valuation becomes a little bit lower in equities, and perhaps we don't support those loftier valuation levels. We also see a deterioration in the price of the bonds. We have a very well diversified fixed income portfolio across core fixed income, emerging market debt, global fixed income, and high yield bonds that help offer a higher yield. So the expectation is if interest rates, and this is on page 40 or 50, please. The expectation if interest rates increased for a period of 1 year, and that's something that we could potentially see. We saw 9 interest rate increases following the global financial crisis that brought short-term rates from 0% to about 2.25%. So we could see that over a prolonged period of time. If interest rates increase for 1 year, the fixed income portfolio could potentially decline by 8%. The impact for U.S. equities are attractive, and generally what happens during a period of rising interest rates, the Federal Reserve is controlling rates to help an overheating economy. Generally, equity markets are performing very well. So while we may see an impact of the overall discount rate on equity valuations, equity markets tend to do well during a period of rising interest rates because that's a measure or a way to pull back a potentially overheating economy. Equities decline by 20%. The impact to fixed income is de minimis. That is the source of protection, especially U.S. Treasuries. And we saw that firsthand. Managers that had or core fixed income managers with above or investment grade fixed income allocation to Treasuries offered the most significant impact. But not surprisingly, U.S. equities will decline. Non-U.S. equities will decline if we see a sell-off in overall equities. Across the other asset classes, whether it's real estate, infrastructure, or private equity, the implications are relatively de minimis. This is a benefit of having asset classes, real estate, infrastructure, private equity, private real assets that aren't valued on a daily basis. We don't see those periods of stress from mark-to-market valuations. There's a smoothing impact that helps mitigate the overall volatility. And now, while there may be some more illiquidity risk like in the asset classes profiled at the bottom, the volatility of those returns are much less impacted by periods of public equity stress. That's also why we have those asset classes in the portfolio. Long-term growth from private equity. Private debt offers duration that's much lower than what we get from a fixed income portfolio. It's variable rate debt that increases or the coupon increases as interest rates increase. And then real estate and infrastructure exhibit correlations that are much lower than traditional asset classes to public equity markets.
Thanks. Is that it?
Yes, sir. Unless there's other questions from the board or staff.
Any other questions? Okay, thank you very much. That was really helpful. And that takes us to the investment performance update for July.
Thanks, Rob. At the end of July, the fund returned for the month 40 basis points positive, which was in line with its benchmark. And over the fiscal year, 1 year and less, it either match or exceeds its benchmark. And you can see the spreads continuing to tighten over the longer time periods, going back to since inception. Estimated returns through Tuesday of this week, the 24th, month to date, 0.82%, which is ahead of the benchmark. Fiscal year to date, 1.26%, also ahead of the benchmark, and calendar year to date, 10.36%, ahead of the policy target as well. No actionable concerns regarding any of the managers. We will provide the update that is due on SGA at the September-October meeting, although I would note that at least recently the performance there over the month, fiscal year, etc., does appear to have stabilized rather significantly. Also intending to bring, assuming or if the board, I shouldn't say assuming, if the board were to approve, we're bringing what would be the final private equity recommendation for the calendar year to the table next month. And that would get us to our annual pacing requirement per the asset allocation. Lastly, we do have about $233.5 million in cash as of this morning. That represents roughly 3 months worth of benefit payments. So at this point, we don't need to draw down or cash out anything to fund those monthly checks to the pensioners. Happy to take broad or manager-specific questions from the trustees if there are any.
Any questions? Okay, that takes us to the staff report.
Securities lending, 94,815 for the month. We've now crossed the $50 million mark since the inception of the program. Diversity and local manager AUM, consistent month over month, 26.23% on a combined basis, 19.25% when diverse managers are broken out as a group, and 9.58% for Philadelphia and surrounding areas. Lastly, the upcoming board meetings, September 23rd, October 28th, and then the November/December calendar will need to be set by the trustees. That's traditionally been a combined meeting in early December, but the board will need to set that date at their leisure for the calendars. That was all we had. Again, happy to take questions if any remain.
Any questions? Okay, thank you, Chris.
Thank you.
Any new business for investment committee? The old business? So moved and properly seconded. The investment committee adjourned. Brian?
Sorry.
Rob, you could just do this by if there are any objections, if you want.
Thank you, Jim. Are there any objections? Hearing none, we are adjourned.
That's how you do it.
That's right, exactly.
Yeah. Moving into the full board meeting, it has been moved and properly seconded that we accept the recommendations made by the investment committee. Now I'll call the roll. Brian?
I approve.
Francois?
Approve.
Vanessa?
Approve.
Marcia?
Approve.
Veronica?
Approve.
Rebecca?
Approve.
Carol? And
Approve.
Ron?
Oh, I approve.
And motion carries. Thank you. Any new business? Any old business? So moved and properly seconded that we adjourn. Any objections? We are adjourned. Thank you all very much. See you next month.
Thank you. Bye-bye.
Aye.
Bye-bye. Bye-bye.
Thank you. Bye.